Ladies and gentlemen, and welcome to the end of our first full week of trading for 2011. Today's January 7th, of course, 2011. Welcome to our standard, or our weekly, I should say, open discussion presentation for power options, for radioactive trading, general options information as well. It's good to see you all here today. As mentioned in the discussion, of course, or the basic description of this particular webinar, today's open discussion is just designed solely for your questions, and I'm going to attempt to answer your questions as best as I can. We don't have any planned material for today's webinar, although I may look for one or two things at the beginning while those questions are coming in. Just out of my own curiosity, I didn't get a chance to do a couple things today, and I wanted to see some things regarding the weekly options and the new series that was released. But again, this whole presentation is geared towards your personal questions that you have maybe about general options strategies, general options trading, the Power Options suite of tools, the Power Options applied service, or the radioactive trading techniques. So welcome, and without any further broad discussion or general discussion, let's go ahead and get started. My name is Michael Chupka. I will be your presenter for this afternoon. I'm the Director of Education here at Power Options. Power Options is a patented suite of search and analysis tools designed for self-directed options investors. And Power Options has been in business for over 13 years. I've had the great pleasure of working with Ernie Zerenner and the Power Options staff for the past 7 years now. I handle a lot of the coaching sessions and education on the site. What the coaching sessions are is if you're a trial member or a subscriber to Power Options, you can register for a free coaching session. There's no limit to how many sessions you can have. They are completely free. And the coaching session is essentially a 35, 40, maybe 50-minute phone conversation. We'll walk you through the tools on the site or answer any questions that you have. I've co-authored 2 books on options investing with Ernie Zerenner, one on naked puts and one on protective option strategies, the different forms of married puts and collars. As I mentioned, we do support over 23 different strategies on the site. I am familiar with all the strategies and versed in all the strategies that we support on Power Options. However, there are certain strategies I do not trade in my personal account. Strategies such as iron butterflies, short straddles, short strangles, or naked call positions do not match my personal risk-reward tolerance, so I don't use those positions in my personal portfolio, but I can easily show you how to use the tools and discuss theory of those trades and management techniques of those positions with you. Now, the processes and procedures for today's presentation. Use the question pod on the GoToWebinar technology to ask as many questions as you want. We may not have time to answer all the questions, but we are going to try to take as much time as we need to go through all the questions thoroughly and not brush any questions off, of course. These questions can be about the tools and Power Options, the radioactive trading techniques, or the radioactive trading website, Power Options Applied or advisory newsletter service, of course, general option strategy discussions, management techniques, and general education. I won't give you any direct advice on a specific position that you might have in your portfolio or anything of that nature, but we can just talk about the basics of management techniques, and I can show you how to use the tools to help you in your decision-making process as you go forward. Now, we have some basic ground rules. We've never had a problem with this before, but we always want to mention at the beginning of a presentation, we just ask that you have respect for all attendees and presenters. Negative behavior will not be tolerated. Please be patient. If you've asked a question, there may be several questions ahead of yours. I'm going to try to get through them all. But, of course, there may be several questions that are ahead of yours. Please feel free also to help us help others. If I'm discussing a question that one of our attendees has asked and your market experience or something that you've seen in the market, you have a different experience or something to add to the conversation, just use that question pod again to send that over to me, and I'll include that in the discussion. And most important, let's have fun. As I mentioned, it's the end of the first week of trading for 2011, the first full week of trading for 2011. Getting ready to head towards January expiration in about 14 or 15 days. And then we'll have the first expiration cycle of the new year behind us, and still looking forward to hopefully more positions and better profits. All right, as you're queuing up your questions, I'll go ahead and prompt you now to start queuing up your questions using that question pod there. I'm going to navigate over to the Power Options suite of tools. And of course, what we're looking at right here is the main screen that a Power Options trial user will see. Of course, for those of you that are just starting your 14-day free trial or trial to power options, you want to make sure that you take advantage of these 4 steps that are listed here. You can request to have mailed to you a printed copy of the user guide, or you can download the free user guide in step 1. Step 2, the flash tutorials. There are several flash tutorials that are available in the Learning Center to help you get more familiar with the Power Options tools, the search tool, for example, and the portfolio tool. Step 3, of course, you're doing part of that now. We host a variety of free live webinars during the week, some that involve radioactive trading techniques and some that are just involved with the Power Options suite of tools, and other webinars that will revolve just around the strategy techniques as well. And as I mentioned earlier, step number 4, that free coaching session. Remember, you can sign up for as many of those as you want as a trial member or as a subscriber. There is no limit, and they're completely free. We do not charge for them. As I mentioned, one of the things that I wanted to look at today that I didn't get a chance to yesterday or today was many of you may be familiar that there are now last time I checked, which was last week I believe, there are roughly 36 securities that offered weekly options. I believe there were 17 standard stocks that offered weekly options, options that expire every 7 days, and there were about 19 indexes, ETFs, and ETNs that offered weekly options. But the new weekly series came out yesterday, and what I wanted to know is just, were there any new stocks that came out? Are there more than 36 securities now that have weekly options? And we're just going to walk through a basic setup on how to identify those weekly options. Now, I'm going to keep it simple. I'm actually just going to use a naked put search, and to look for all of the securities that have excuse me, an available weekly option, I'm going to look for the weekly series, but I'm only going to look for the at-the-money strike price on the available securities that have weekly options, so I don't have duplicates. I won't see 3 different strikes, for example, on Apple or on OEX or on SPX. I just want to see the at-the-money option to see a list of securities. Now, how I'm going to accomplish that is I'm first naturally going to go into the search tool, the patented search tool for the naked put strategy, and this is going to pull up, of course, the results for the naked puts in the market that match the default criteria that are listed below the results table. So I'm going to scroll down below the results table, and this is our parameter field where in any strategy we can put in up to probably 20 to 25 different option criteria, or about 25 to 30 different stock criteria to identify the positions that we wish to see. And I'm going to scroll down to the very bottom. And this is the same steps I would take when I'm just creating a search from scratch. What I'm going to do is down at the very bottom we have 2 buttons, one for submit these settings if I made any changes to criteria, and a button for clear these settings on the right. Well, I'm going to clear these settings. I'm going to empty out every criteria that's in the search field for this naked put screen. Now I'm going to scroll back up to the top of the parameter field. I'm going to identify weekly options, just 1 strike each for the securities that have weekly options. And to do that, I'm going to go first in the far left to the option expiration time frame, and I can do 2 things here. I can select all months from the option expiration time frame, or I could also simply just select January, since the weekly options would only have a January series right now. But I'm going to go ahead and leave it at all months, and how we're going to filter it down to the weekly options is use the days to expirations fields beneath that. Now, I know the current number of weekly options that are available for this week that are expiring tomorrow. What I don't know is next week. So I'm going to put in my days to expiration from 3, so it'll start technically on Sunday, to 9. And that's just going to give me that 7-day time frame. I'm going to be within that 7-day time frame. Now, to narrow it down to just 1 strike each, or the at-the-money strike, or the just out-of-the-money strike for each series, down below that, of course, I have the range for show in the money and show out of the money for the strike prices. And I can screen by number of strikes or percentage. What I want to do is just use the number of strikes out of the money, and I'm just going to put in 1 to 1. This is a greater than and less than field. If I wanted to see all those naked puts that were more than 2 strikes out of the money, I would just put in 2 to blank. But for here, narrowing it to 1 to 1 is just going to show me that 1 strike out of the money. I'm not going to put in any other filters. All I'm telling the system to do is show me any securities that have weekly options and show me just the out-of-the-money strike on all of those securities. All right, so now that I've made that change, I'm going to go ahead and click Submit these settings. All right, now this gives me I'm still sorting it, of course, by percentage naked yield from highest to lowest. But what I want to know now is what is the total number of results that I have. Ooh, and I see that I have 40 results. Down at the bottom, it shows me that this page is showing me the top 20 results out of 40 total results. So it appears now that there are 40 securities that are offering weekly options that expire in 7 days, that expire next Friday. Actually, none of these on the first page look new to me, except for JP Morgan. I think that's a new one that was added recently. General Motors, I know, was added at the end of December. They have a series coming up this week as well, so they were already in there. I know Bank of America and Baidu. Well, let me go ahead and navigate to the second page. I just want to see what's available on the second page here. I think Research in Motion is new. Or maybe there is a duplicate. Maybe GM did show up twice for me. That's a possibility. What are the other symbols? EEM I'm not positive of. I can check that to see if it has an expiration today. Cisco I think is new. I don't think that was available last week either. So those are some of the new positions that are there. Now we have here our list of 40, excuse me ladies and gentlemen, our list of 40 securities that have weekly options, or list of 40 that have weekly options. And this includes both the standard stocks and the ETFs that have weekly options. If I wanted to narrow this down to just the standard stocks without looking at the indexes and ETFs, well, we'll go back to the parameter field. And at the bottom of the parameter field there, I have a field for recommended lists in the center here, a field for recommended lists, and a field for remove stock lists underneath of that. So in the remove stock lists field, I'm going to go ahead and select indexes, ETFs, and holders. I'm just going to remove those lists and hit submit. Now I think one of my ETNs is actually going to show up in the stock list. It's not going to be filtered out. And there it is. Of course, this the VXX, the Volatility Index Short-Term Futures ETN, is not considered an ETF index or a holder, so that is included with the straight stocks. And it looks like now there are 24 stocks that offer weekly options. We have things such as AIG, Las Vegas Sands, Priceline, Massey Energy. I also think that's one of the new ones. British Petroleum, Potash of Saskatchewan, JP Morgan Chase, Netflix, Amazon, Bank of America, Baidu, Ford, Goldman Sachs, American Express, General Motors, Research in Motion, Google, General Electric, Apple, and go to page 2, and what else do we have here? Microsoft, IBM, Citibank, excuse me, and Cisco. So those are the 23, 24 stocks that offer weekly options. Of course, the remainder of the 40 series that we saw, those were roughly, that means that we'd have 16 ETFs and indexes that offer weekly options. So that's just a quick review or a quick discussion of how you can easily identify the weekly options using the search tool. We're doing naked puts, but you'd follow the same process if you're doing a covered call. We would have opened up the covered call search, scroll down to the bottom, hit clear these settings, put in our expiration time frame. We could have selected January or all months, and then we would limit it by the days to expiration. So we would have only put in, 2 to 9 or 3 to 9 days to expiration to show us the series that expire in on Friday of next week. Now, I narrowed this down to just show me one strike of each of the securities by using the range out of the money. Let's say we were interested in trading weekly options, naked puts on stocks or ETFs that offer the weekly options. We'll just stick with the straight stocks for now. We'll continue to remove the index and ETF list. But let's say we had a different criteria. We wanted to trade the positions that had weekly options that expire next Friday that had at least a naked yield, let's say, of 1%. So we'll just go ahead and put in 1 to blank on our percent naked yield. I want to make sure there's some open interest, so let's put in a limited open interest of at least 50 contracts here. Maybe I want to make sure that my bid price, my option bid price, is at least 15 cents. Now, let me pause there for a moment and discuss something with everyone that I'm sure you're probably familiar with. Many of you are probably trading options right now. Maybe you're doing spreads. Maybe you're doing covered calls. Maybe you're doing married puts or following the radioactive trading techniques. You might already have a search created in Power Options, or you have an idea of what you want to look for. For example, if I'm doing a credit spread, a bull put credit spread, when I'm looking for a standard expiration, I might want to look for positions that have at least a 75% probability of success, offer a net credit of at least 50 cents, and I'm looking for a leverage return of at least 8% or more on my positions. Well, it's not as easy to just pull up your search that you might already have on Power Options and change the days to expiration and expect to identify positions. Naturally, the weekly options are going to have a much lower premium. You're going to receive a much lower net credit if you're doing a spread, and your percentage return is going to be much lower. Now, your annualized return using weekly options for these kind of positions, when you're selling premium or doing the income strategies, your annualized return is going to be much higher. However, the static return up front and the static net credit is going to be much smaller. So I can't use the same criteria. Sorry about that. I can't use the same criteria I would for a normal expiration looking for an 8% return and a 50-cent net credit, because the weekly options wouldn't offer that. I have to lower my expected return. I have to lower my expected option bid because we're dealing with a much shorter time frame. All right. Well, I've got my days to expiration set for my weekly search for naked puts. I'm using an open interest of 50, minimum bid price of 15 cents, and a naked yield of greater than 1%. We might actually have to change that naked yield and drop it down to about 0.5%. Now, when we trade a naked put, of course, we want to start off slightly out of the money. So I'm going to use just a basic percentage out of the money. I want to make sure I'm at least 1% out of the money or more, that my put strikes at least 1% below the current stock price. Now, I'm not going to use any stock filters on this particular search. Why am I not going to do that? Well, the universe of stocks that have weekly options is so limited. We just saw that earlier. It's only 24 stocks. So I don't need really right now to further filter it by trying to use stock criteria looking for stocks that have strong fundamentals or strong technicals. I might end up with no results if nothing matches. So I'm going to keep it basic first, not use any of the underlying stock fundamentals or technicals, and just run this basic screen looking for the naked yields, open interest, minimum bid price. All right, we see we've narrowed this down to 9 results. We've got AIG, 2.4% naked yield, stocks at 61.18. You could potentially sell the weekly 60 strike put for $1.42. You got a 60% probability that the stock would remain above that price. So we don't have a lot of strikes here that are giving, again, a high premium or a high naked yield in this case, because we're doing the naked put screen, and that's because we have such a short time frame to expiration. There's not a lot of time premium on these particular options. You might want to say, well, if I'm doing a naked put, I want a higher probability. Most of these positions, these 9 positions, looks like the average the average probability is around maybe 62 or 63%. There is a standout here. The 57.5 strike put on AIG is currently priced at 61, 64-cent premium. So it's a 1.1% naked yield for 7 days, and that has an 80.9% probability that the stock would be trading above that price at expiration. Well, that might be something you might want to look into a little bit more. But there is another catch. I don't know about you guys, but whenever I'm doing a credit, I'm opening a new credit spread, or I might be opening a new covered call. Many of you know, of course, I don't do covered calls by themselves anymore. I use them in different contexts. I only trade standard callers or married puts, and then I might sell a call after that because I'm just a little bit more conservative now. But when looking at this field, one thing I do tell all my customers, and that I would do myself if I was opening a new covered call, a new naked put, or a new credit spread, especially in this cycle, is I want to avoid positions that have an earnings coming up. I don't want to get stuck with anything or a pre-market or after-market spike or drop that could cause me a lot of unexpected loss on the position. So down again below that percent out of the money field, we have a selection box for earnings date, and I can select specifically to look for stocks that have an earnings between now and expiration, or not between now and expiration, or between now and a certain number of weeks from now. Well, I'm going to check the box for not between now and expiration, and let's see if that affects our results any. I'll go ahead and hit submit these settings. And let's see what we get here. There we go. Okay, well, AIG is still there. So that one with the 80% probability with the 1.1 naked yield for 7 days might still be an opportunity. But now we're down to 8 results. So one of our 9 results was filtered out because we told the system not to show us any positions on stocks that have an earnings between now and between expiration. Now, as I mentioned, we had filtered out already the indexes and ETFs in this case for the weekly options. But and we're just looking at the straight stocks, excuse me. But if I wanted to reverse that, if I just wanted to look at the naked puts that were available on the indexes and ETFs and not the standard stocks, well, we would just swap what we had in our recommended list and remove stock list. Remember, we had opened the recommended list up. We're looking at no lists, so including the entire universe of optionable stocks. But we selected to remove the indexes, ETFs, and holders. Well, from my remove field now, I'm just going to select no lists. And now in the recommended lists, let me just select indexes, ETFs, and holders. Let's click submit. Okay, not surprising. We only have 2 results in the indexes, ETFs, and holders that match our criteria. Part of the reason why is because on average, even though the stocks that have weekly options now are more stable stocks. We saw names like GM, Apple, for example, IBM, and so forth. But a lot of the times, the standard ETFs and the indexes have such a low volatility that we might not be able to get this 1% naked yield. We might find a 15-cent bid, but we might have to lower the naked yield to find more results. And right now, the only ones that match our little criteria, even though we're only using 3 criteria to filter by the weekly options, is a FAS, and that's the financial 3 times bull, so it's a 3 times leveraged, and of course the gold miners ETF, which probably has an increased volatility now because the gold and silver have been bouncing all over the place, seen a recent decline over the past few days. Let's test that. Let's just adjust our naked yield. Let's see if I know what I'm talking about or I'm just blabbering endlessly. Let's lower our percent naked yield down to 0.5% instead of restricting it to be 1% or greater, and see if we get any more results on the ETFs and indexes. We'll just click submit these settings again. There we go. Now we have the oil ETF in there. We have another one of the FAS, that 3 times. We have another gold one, and we've got the SLV, the Silvers Trust. So we see we have a 0.6% naked yield and a 0.8% naked yield. So volatility does come into play even with the weekly options because with such a low volatility we have a lower premium, thus we get that lower naked yield. Might not be a reasonable trade depending on what your goals are and your expectations. One other small piece of advice I might mention is that if you are doing the weekly options either in the bear call credit spread search, I should say vertical spread search with credit spreads or debit spreads, or with naked puts or with covered calls, because the return, the weekly return is so low, rather than screening for a percent return if assigned if you're in a covered call, or a percent naked yield for the naked puts, or a standard return for the bear call credit spread, this is one time I might suggest you might want to actually use the percent annualized return or the percent naked yield annualized so that you can see how much more the annualized return is for your weekly options opposed to the standard option that expires in January in 14 days or in February in about 45 days. And that's personal choice, though. That's really personal choice. But sometimes it's better to use that annualized percentage return on the weekly options so you can increase it a little bit more. All right, let's see here. Let me go now and navigate back to the main home menu, and I'm just going to go ahead and look at some of the questions that came in. All right, Francisco wants to know, I'm holding large interests in a given stock plus options on the same. I'm assuming you mean you have long stock and long call options on a particular security. Earnings reports are coming out soon. How can I protect myself from unexpected surprises? Any strategies for this? Well, I'm going to discuss something that's very basic but very obvious, and it always kind of makes me laugh now seeing where I am in my options education and my options trading now compared to where I was 7 or 8 years ago when I first started. When I first got together with Ernie and the Power Options group here, the Power Options staff, I didn't know anything about options. I kind of knew what options were, but I'd never traded them. I'd never traded a stock before 8 years ago. I'll be directly honest with you. I learned how to do this over time. I started handling the coaching sessions by myself when I was about 3 months in to Power Options, when I've been working for Power Options for about 3 months after I got really familiar with the site and all of the option strategies. Now, I've been trading for 8 years, and I, talked to about 50 to 60 people a day, 50 or 60 investors, subscribers, and new potential subscribers a day on the different strategies and the different techniques. I'm not beating around the bush here, but I just wanted to give a little bit of funny history. I started doing covered calls and naked puts. That's what Ernie was doing. That's what he had been trading for the past 20 years, and that's what he originally taught me. And after I had a few losses within the first 4 or 5 months, I even got burned with stop losses. I started playing around with standard collars, and I was actually much more comfortable with standard collars. And as I got more comfortable with those after trading them for about 4 or 5 months, and now I'm about 9 months in, been working for Power Options for about 9 months, I would still get calls from customers who are trading covered calls or naked puts. And the customers who are trading covered calls say, well, how can I protect this position? I know I can make a good 3% return, but I don't want to lose any money if the stock goes against me. I said, well, the only way to ensure that is to buy a put. The only way to get one-to-one protection on a stock, or to be able to protect a long call that you have against a downturn, the best way to get the best protection is to buy a put, is to put more money in the position to buy insurance, whether you have a long call or you have a long stock position. I can guarantee you that 95% of the customers that I told that to never bought a put. Who wants to do that? Who wants to buy a put on a covered call and turn it into a collar because it's taking away from your profit? We don't like to admit that we might be wrong after we've done all this research and analysis. We decided this is the position that we wanted to get into. Of those 95% that never probably bought a put, every time I told them that and they were discouraged, said, well, no, isn't there some other kind of ratio spread that I could use so I can still generate premium and protect my shares? Well, no, that's not the way it works. You can't get something for nothing. But of those 95% that never bought a put on those positions, probably 100% of those 95% at one point suffered a loss in which they had bought a put instead of trying to use a stop loss or some other kind of elaborate protection to ensure their positions. So I always like to mention that because for the first 6 months, for the first 5 months when I was trading options, I didn't want to hear it either. No, I spent 15 minutes. I spent an hour researching this stock and deciding this is the covered call I want to trade. I don't want to pay money out of my pocket to ensure their position because that's admitting that I'm wrong. I don't want to do that. That doesn't make any sense. Why do I want to take away from the potential profit I was making? Well, once you start looking to make 2 or 2.5 or 3% on your in-the-money covered calls that have a high probability of getting assigned, 4 of them get assigned for the 2%, but 3 of them drop down 10 or 15% and blew through your stop loss, and you realize you're worse off than when you originally started, then you start to see the advantage of this is why you need to ensure your positions one-to-one by using put options. So, Francisco, long story short, that's my answer, is that I really think you should look to purchase put options on that large investment. I know it costs money to buy the put options to ensure yourself going through an earnings period, or even those long calls, for example, but why do you want to, why would you want to do anything else? Why would you want to enter into an elaborate spread position that might generate some premium but actually increase your risk if the stock goes against you, or do anything like that? If there was some hidden way that you could just use a quick options transactions to protect your holdings and make sure that you wouldn't have a large loss if earnings were terrible, I would definitely share that with you. I would definitely tell you what it was. The truth is there isn't. Those elaborate techniques of doing additional ratio spreads or other positions on top of a long stock or on top of a long call may actually increase your risk. And also, though, the other aspect is they could reduce your return if the stock spikes up. You have this large holding, maybe you could consider that insurance as well. So I do this elaborate ratio spread. The stock suddenly swings up because the earnings were favorable. Instead of making the 12 or 15% gain on the stock, I only made a 6%. Because by generating premium with this elaborate spread, I also limited some of my upside gain. All right. So here's what I would suggest you do, Francisco. The first step is I think you should go into the Married Put tool, or the Married Put tab, excuse me. You might want to go into the Insurance tool. What the insurance tool allows us to do, and this will work whether you have a gain in the stock right now or not. What this tool is designed to do is you can put in a stock symbol, and I'll just go with something I discussed with a customer earlier this afternoon. This customer had shares of Apple, and I'm just going to put in a cost basis of $280 right now. Okay, and you have a field here for buy put month, and I'm going to leave that at all months, and then sell call month, and I'm going to leave that blank. All right, so I'm telling the system that I have Apple, shares of Apple at $280 per share, and I'm going to leave the buy put months at all months, and let's hit calculate. Now what this tool was designed to do is that if you have a stock that's moved up in price, and right now you have an unrealized gain. Oh, nice round numbers, how about that? In this particular situation, Apple is currently at $336.12. So I have an unrealized gain. I have a stock with a gain of $56.12, or 20% of that original investment process, or original investment amount. So sometimes I find, and this, I don't mean to joke about this, but sometimes I find the hardest thing to do in any trading, or specifically in options trading, is what to do with a position once you have a profit. You're faced with three choices. Liquidate now and take the profit, meaning that you're happy with this gain and then you're going to lose out on any potential further upward profit on the position. Number two, try to sell a call to generate some premium against the position right now. And what that might do, of course, will generate some premium, but if the stock falls, you might give some of that profit back. Or if the stock takes off and continues to move up as it has been, you've capped your gains essentially. Three, just leave the position alone. And that really should be number two. But three, leave the position as it is. Well, if the stock continues to go up, you might realize a more profit, but if the stock falls in price now, you're going to give back some of your returns. Or, opportunity number four, ensure some of those gains by buying a put option. And that's what this tool did. What it shows us down below is we have opportunities for the available expiration months. So up close, we see we could buy the February 370 put. This would cost us $36.25. So our new investment into the position would be $316.25, $280 original price plus $36.25 for the put. But remember, we're buying a $370 put, so we have locked in a $53 profit, or 17%. That's still most of our original gain. Now, what does that mean? Well, if my my earnings date is coming up soon, what that basically means is that in January, when the earnings date comes out, if the stock moves up, I haven't capped my gain, so I still might realize some increased upside profit potential. But if it falls, I'm still guaranteed to make 17% on the position. I can sell to close the put, it will gain in price, and so forth. Now you even have availability for further out in time. If you want to go 70 days out in time, 99 days out in time, or 190 days out in time, you can evaluate between these different positions. But Francisco, even if you don't have a gain in the stock right now, you could put that value in just to see, what your new risk would be. You would be limiting your risk by buying the put option. You can kind of mimic this for a long call as well using the put options. I don't normally advise doing that, but you can do it, and here's what I mean. Let's say you were trading Apple. You might not be, Francisco, but let's say you were trading Apple, and you had 280 strike calls you originally paid $30 for. Well, to me, that's kind of owning shares where your strike price is 280 and you paid $31 for it, so that's essentially saying that your cost per share is roughly $311. So for the long calls, I might just put in a cost basis of $311, the strike price of your calls plus the call premium that you initially paid. And just hit calculate, and you can see what puts you might be able to link to that for the position. Another possibility that you could do that I don't have a tool on it for power options, but in the power options blog there was an old article I think written in 2008 that talked about portfolio insurance. What I'll try to do, Francisco, is send you a link to that blog article. And what that essentially discussed is an equation that could be used. So let's say you look at your portfolio and you see that you have, of your current holdings, 50% of your holdings are in stocks in the S&P 500, 25% are in stocks in the NASDAQ 100, and the remaining 25% are in different stocks that are mixed. Well, this equation allows you to say how many of these contracts would I need, how many put contracts would I need to purchase on a particular index or an ETF that would help me protect my monetary investment in the S&P 500 stocks or in the NASDAQ 100 stocks, for example. So you do still have to put in more money. This is an approach that's used by advisors and financial advisors, I should say, and money managers. But the trick is it's not always a great way to protect your personal position. When you told me that you said you're holding large interest for you in a given stock, I think the best way for protection, Francisco, would be to go one-to-one with puts specifically on that stock price or puts linked to those call strike prices. Here's a problem I've seen in the past. Let's say that 80% of my portfolio, I know that's a lot, I would never do this, but this is an example. 80% of my portfolio is in holdings on the NASDAQ stocks, the tech stocks. And I decide that I have a large holding, let's say, on Apple, and I have a smaller holding in Microsoft, for example. Well, I decide that I want to protect everything, so I would go and buy puts on the index or on the ETF that mirrors the NASDAQ, the cubes, for example, in case there's a bad earnings season. Well, unfortunately, what can sometimes happen is, as I mentioned, the majority, let's say, of my holdings, I believe I said, was in Apple. Let's say it was in Apple. Let's say Apple has the poor earnings report, and the stock drops 12 or 15%. I know it's a little bit outrageous. Let's just assume it drops 12 or 15%. Meanwhile, either the week before, a couple days before, or a couple days after, Google comes out with good earnings, Microsoft comes out with good earnings, and let's say even Yahoo comes out with good earnings. Well, here's part of the problem. The index might actually have moved up a small percentage, even though one of those holdings in the NASDAQ, in the cubes, Apple, dropped down 12 or 15%. This is now a problem because I've lost money on those puts that I was covering in that particular index, while the stock that I was holding that was a major portion of my portfolio has dropped significantly. So I didn't really protect that. I did protect the security or the sector or the industry as a whole, but it is possible that one of the stocks that's a large holding in your account might have a poor earnings and decline, while all the others in that sector will be moving up. And that can be detrimental if you're just holding puts on the index, because you'll lose money on the insurance policy you purchased and you lost money on that stock that was a major part of your portfolio holdings. So I think the one-to-one ratio is a better way to go. I know you got to pay a lot of money to do that with one-to-one, buying the puts on the stock or buying puts on the calls that you have to limit your losses, but that is the best way to do it. We don't always want to hear that, but that is the best way to do it. Could it be lost money? Now, I never really consider it lost money, but I understand what that kind of question would be. Yes, I pay an extra $15,000 to cover this large stock holding my position by buying puts or buying puts linked to the calls, and the earnings are great and the stock moves up, and the puts essentially, deteriorate in value, or I lose 35 to 40% of that $15,000 I invested. Yeah, maybe you can look at it as lost money that way, but what would happen in the other situation? What would happen if everything went against you? Excuse me. All right, Harold wanted to know, regarding married puts, and of course I'm assuming the radioactive trading technique that's advocated at Power Options, I trade in my personal account. All of you that have attended a webinar know that. But regarding the married puts, when a position does go against you, do you wait until expiration to get out of the position? Or, I'm sorry, some glitchy there. Or, how do you control this loss? Well, that's all discussed in the blueprint, Harold. And I'm not trying to dodge the question, but that's all discussed in the blueprint. Number one, I'll tell you straight out, no. I never hold my married puts all the way to expiration. The reason why when I open a radioactive position, following Kurt's rules, I buy a stock, I buy a put that's at least 5 months out in time and in the money, but no more than 20% in the money and has the risk that I'm looking for. The reason I'm buying the put 5 or 6 months out in time to begin with, I'm just going to navigate over to the main search tool for now so we have that in the background for the married put positions. But the reason I'm going 5 or 6 months out to begin with, Harold, is because that's taking advantage of one of the 3 core principles in the blueprint and the radioactive trading technique, and that's the red line, the radioactive decay line, or let's just call it the time value decay line for any option. And when you see that curved line, that logarithmic line, I don't have a great view of it here, but you know what I'm going to do? I'm going to go back to the main Married Put homepage for a second. I'm going to scroll down here for an open screen. All right. We're going to do a little drawing here. We're going to do a tablet, all right? So here's what I'm going to do, and let me try that again, all right? It's hard to do. I hate trying to do this with the mouse. Let's try that again, shall we? Yes, we're going back to kindergarten, ladies and gentlemen, and I apologize for that. So let's just do that. Okay. So what we're essentially looking at here on this pink curved line I just drew, this is essentially the decay line. It's probably a little bit more steep at the end than I wanted it to be, but let's just take this as an example. This would be the decay line of an option, assuming everything stays the same and volatility doesn't change. So this range might be 6 months out, and this range might be 5 months out. And here we'd be maybe 4 months out. Right here, when we start to enter in the slope, we might be 3 months out. Here's about 2 months out, and this would be 1. All right, so these are the months out in time: 6, 5, 4, 3, 2, 1. The reason why we're looking for options when we're trading radioactively that are at least 5 months out in time or more is because we want to be on this side of the time decay factor. So when we open the Married Put position, if nothing happens in the first 30 days, if the stock doesn't move and volatility doesn't change, we know that rarely happens, but assuming that it does, I'm not going to lose a lot of this time value. That's going to remain fairly constant. I'm losing some, but not a lot. Remember, time value is our true risk in the Married Put position. That time value we paid for the put, that is our true risk on the position. Now, why am I explaining this? Just to answer the simple question, or it wasn't even a simple question here, but why am I going through this to answer your question? If I've been holding a Married Put position and absolutely nothing has happened, if the stock has stagnated and I've seen no movement, by this point, you know, entering into about 3 months left to expiration, I didn't mean to draw over that 3, I apologize. What I've probably done is done a couple of the neutral income methods. I might have done an income method number 8, or I might have tried to do an income method number 6, just to reduce the risk a little bit. Can't really do any of the other income methods. Well, I shouldn't say that. I wouldn't really have a good opportunity to do income method number 1 or income method number 3 or 4 unless the stock had moved up. In this time zone, I might have been able to apply an 8, a 6, or maybe even a 5, depending on what premiums were available at the beginning. So that might have worked for me. But if at this point I still am not seeing any gain in my stock and I haven't been able to do many income methods, I'll probably cut the position right here. I'm not holding it for the next 2 months where I just see that rapid time decay unless I am really, really positive that the stock's going to start moving. Okay? But in the blueprint, there is a full chapter on exiting RPMs, and Kurt and Ernie discuss in there what their approach is. And there's even discussion in that section of, you know, if you haven't seen X within the first 30 days, if it hasn't matched your SIGA model, you might want to consider adjusting the position. If you see the stock, let's say if your stock maybe drops to where its 50-day moving average is now below the 100-day moving average, you might consider that an exit signal. There's some rules in the blueprint that are discussed for that. But assuming nothing else like that happened and the stock just stayed straight line and stagnated, Harold, I'm usually out of the position once I reach about 60 days left to expiration or maybe even 70 days left to expiration. I never hold an RPM to expiration unless I've already got such a strong profit on it and I've currently opened an income method and I just want to hold it there. Okay, let's see here. Let's see, what other questions do we have? I hope that that helped answer your question there. And I'm sorry for the crude drawing. It's not easy to do. In the near future, I'm not positive on this, so I don't want to go ahead of myself, but in the near future, I'm working to potentially upgrade the service that we use for our webinars to have more availability for directly importing images during the screen slide, being able to have chalkboards that are easier to draw on and things of that nature, and that will greatly enhance the experience, so I hope to get to do that in the near term. Oh, Norman, I'm sorry. Norman asked a question here. Can you show how to also sell a call on the Apple example along with buying the put? Oh, yeah. You just have to select which call month you'd want. All right, so let's go back to our example. I'm going back into the insurance tool in Married Puts. We're going to put in our same Apple example. There's AAPL. Our cost basis, oh, is it 280? Yeah, 280. And We're going to narrow this down a little bit, Norman. I'll leave all months for the puts. Oh, I don't like doing this. I'm going to select February for the sell call month. And what I said when I don't like doing this is I was afraid to select January because, lo and behold, Apple's one of our positions that has a weekly option. So rather than seeing all the combinations that in January that have 7 days left to expiration and the standard expiration of 14 days, I'm just going to skip January and go right to February. But let's go back to square one. I apologize, Norman. I didn't mean to bounce around like that. Let me go back to square one. Here's where we started off, isn't it? We had Apple, cost basis of 280. We selected all months for the buy put month, and this gave us our results for the various expirations and the different strike prices where we could have a locked-in profit. Now, if I just wanted to do a wide example list or a wide potential list for doing the collars where I'm long the put now and short the call, now I'll just simply change the call month from none to February. We'll just go ahead and click on calculate. Now, I'm actually very glad you brought up this example, Norman, because I do want to show some things. I want to make sure people are aware of certain things they might see when running this example. And as I expected, the first 5 or 6 results are exactly what I kind of did not want to see, but they come up. They're legitimate trades. They're still going to lock you into a high profit, but some of the best opportunities in the system that will lock in the highest profit are what are called conversion positions. And let me tell you what I mean by that. The first result that came up for our collar series, and remember, collar by standard definition is any combination of long stock, long a put, and short a call on the same stock or the same security. Doesn't matter if the put's 8 months out, 9 months out, if the put's in the money or out of the money, if the call is 1 month out or if the call is 8 months out. Just collar definition is long stock, long put, and short call. Now there's these little tricky names for all of the different variations, and these particular ones that give you an immediate locked-in profit and guaranteed return are the conversions. Our first example is we could buy a February 340 put for $14.90. There's $11.02 of time value in that position, and at the same time sell the February 340 call for $11.30. Remember, we had a cost basis of 280. We have an unrealized profit of 20%. Now it's showing us we can buy an in-the-money put at 340 and sell an out-of-the-money call at 340 for February. No, they're both at the money. I'm sorry, the stock's at 336. I apologize. They're both kind of at the money. But the call premium at 11.30, which is all time value, is higher than the put time value, which is at 11.02. So we're going to receive a small premium up front for doing this. It looks like a debit because of the intrinsic value, but really in time value we're receiving a premium here. Well, this makes my total cost basis $283.60. Okay, so we're paying $360 extra to enter this, but that's mostly intrinsic value for the put option. My locked-in profit is $56.40. So I have a 19.9% return, a guaranteed return of 19.9% or locked-in profit on the put side, and a guaranteed percent return if assigned of 19.9%. Well, how does that happen? Well, that's the rule of the conversion. You see, we're using the same strike in the same month. We're going to buy a February 340 put that's at the money and sell the February 340 call, which means by creating this collar, if the stock moves up in price, it goes above 340 by February expiration, we're going to be forced to deliver our shares of stock at $340 to lock in a profit of $56.40. If the stock drops, if the stock remains below 340, if it drops below 340, well, our call will expire worthless, and we'll sell to close our shares of stock at 340. So we have a guaranteed profit of $56.40. Yes, this is a straight line profit and loss chart. That's what a conversion is. Now, fortunately, this conversion actually works because we already have an unrealized gain in the stock. Let's just take a look at the profit and loss chart there to evaluate this particular conversion. All right, and there's your chart. Looks fake, doesn't it? The blue line is showing us our monetary gain at a, oh, there is a problem. I'm sorry, there's one small problem here. There it is, okay. What this did, unfortunately, when I linked to the profit and loss chart from the insurance tool, it grabbed the current price. I need to change the stock price to my price of 280, remember. Now let's take a look at that profit and loss chart. There we go. How about that? Okay, so now we've got a February short call and the 340 February short call and the 340 February long put. Straight line profit and loss chart. If the stock is above 340, we get assigned, collect $340. Our cost basis, as we saw on the other page, was reduced down, was still only $283.60. So there's our $56 of guaranteed return. And on the downside, if the stock's trading below 340, we'll exercise our put, sell to close our stock at 340. We've made $5,600. So whatever the stock does at this point, we're guaranteed 19.9%. That's the conversion. Now you can go through that whole list. Excuse me, let me close down the profit and loss chart here. You can go through this whole list and look at those other combinations of what if I bought the 350 put and sold the 360 call. There's a lot of combinations here because it's Apple and there's so many different strikes. If we were using a different stock, we wouldn't see as many. I'll use one of my favorite examples, one of my recent examples, a lower price stock of Silver Wheaton. And I believe the stock right now has dropped recently. It's still at $34 per share. So let's say my original cost basis was $28. That's almost exactly reversed, or not reversed, but that's almost perfect ratio, isn't it? We are using a cost basis of $280 for Apple, and it's currently at $336. And I think Silver Wheaton's around 34, and we're going to put in a cost basis of 28. So let's go ahead and, yeah, there we go. Almost percentage equal, 19.7%. Silver Wheaton's at 33.51. So our ratios work out about the same here. We don't have as many different strikes as we would for Apple. All right, so right now with this theoretical position, we have an unrealized gain of 19.7%. We see the locked-in profit we could make with the puts by purchasing the put options for the different months. Now let's go ahead and simulate selling a February call against that and see what our new positions are, and I can almost guarantee a conversion is going to come up at the top of the list with the best guaranteed return on either side. Yep, and pretty much the same thing. Remember we saw the February 340 calls on Apple with our price? Well, sometimes ratios work out perfectly. Here's the February 34 call for the February 34 put for 272 and selling the February 34 call for 223. No matter what happens, a guaranteed return of 19.3%. But you can still scroll through and look at the other combinations. You might have a combination here where you're buying a March, out of the money put for, let's say, buying the March 30 or 32 put and then selling the February 34 call, almost creating a synthetic calendar. So you'd be able to scroll through that and see the different returns if assigned, the locked-in profit, for example, and the monetary locked-in profit as well. So just change the call month to what you'd want to see there, and that would simulate doing the position. And just change that drop-down menu, and then that would show you the potential collars. And then remember, it's always a good idea when doing the potential collars, even the married puts, and once you have the positions, go ahead and link over to that profit and loss chart. See what it looks like graphically as well as numerically to make sure that it matches your goals and your expectations. Now, I had mentioned a little while ago about how it's a good thing that we have an underlying unrealized profit in these examples when looking at the conversions. The reason I mention that is that conversions don't make a lot of sense for retail investors. Doing a conversion right out of the gate doesn't make a lot of sense. If you go into the collar menu and you go into the search tool for collars, you go in the collar strategy and go into the search tool, I do have a default search created that is looking for conversions. Let's see here. Let me just change this. Let me just do this here. So you click the drop-down menu at the top of the parameter field, and one of the default searches here is just conversions. And sometimes this comes up. I need to make a subtle change here. I just make a subtle change. I'm going to make sure that the call expiration date is equal to the put expiration date. I just noticed the other day that that doesn't always save correctly, but that's all right. That'll be changed over the weekend, so you won't have to worry about that. Well, what do I mean by it doesn't make sense for a retail investor? Let's take a look at this first result. You see a lot of these have just a zero gain or zero loss. The ones down at the bottom after the first 12 or 15 results. Here's our line at the, Alcoa. Everything below this line down here, zero potential return, Zero potential return if assigned, a zero potential return if unchanged. Well, that doesn't make any sense because we're not even including commissions, so that's going to be a guaranteed loss. The top result we have right now for the conversion screen is Huntington Bank Shares, never heard of this company before, HBAN, currently at 709. So we could sell the February 7 strike call for 45 cents and buy the February 7 put for 34 cents. So we receive 11 cents of net premium, and we paid 709 for the stock. So now our new break even is 698, or our total into the position is $6.98. But I've got a 7 strike call and a 7 strike put. So no matter what the stock does, we're guaranteed a profit of 2 cents. If the stock is trading below 7, the call expires worthless, we exercise our put, we make 2 cents because our cost basis was $6.98. The stock goes above $7 or stays above $7 as it is now. The put expires worthless, we get assigned at 7, we make 2 cents of profit. All right, so if I did 500 shares, hey, fantastic. I did 500 shares of this position, bought 500 shares at 709, sold 5 February 7 calls for 45 cents, bought 5 7 strike puts for February for 34 cents. Well, let's look what our total value would be. Let me go to the profit and loss chart, and I'll just put in 500 shares, 5 put contracts, and 5 call contracts so we can just analyze the monetary value. All right, so I want to go 500 shares, 5 calls, 5 puts for a February conversion opportunity. All right, so now what have I done? Well, we've increased our value. Sorry about this dip here. It just happens. You know why this happens. It's a divide by zero error because there's no gain or loss. There's a zero profit at the halfway point. So let me just go ahead and remove that, and we'll just look at the straight profit and loss chart. All right, so 500 shares of this stock, selling 5 calls and buying 5 puts. My total investment monetarily would be $3,490. My guaranteed exit is $3,500 either side, right? Because I've got 5 contracts with a 7 strike on the call and the put, so I'm guaranteed to get $3,500 back, 500 shares times the 7 strike. So that means my guaranteed profit is $10 if the stock's trading below 7 and $10 if the stock is trading above 7. What's the problem? This is a 3-legged position. I might have to pay $8.95 to open 500 shares of stock and pay $5.95 to sell 5 call contracts and pay $5.95 to buy 5 put contracts. So what are we looking at now? We're looking at basically $21 of commission costs, and this isn't $10 guaranteed profit times 500 shares. This is $10 profit on 500 shares. So with even if we were lucky enough to get a $20 commission for this 3-legged spread, or even $15, we're now guaranteed a $5 loss because of commission prices. So this is why, for the normal retail investor, conversions don't make sense. There are occasionally conversion opportunities out there. They do tend to dry up quickly when they are available. The search tool will absolutely identify them for you if they're there, but you may be trading as much, to make it really logistical, to make it really worthwhile, you might have to trade as much as 10,000 shares or 15,000 shares of stock and be selling 100 call contracts and buying 100 put contracts. It just gets out of hand real quick. So opening a conversion from scratch doesn't make a lot of sense for retail investors, but if you have a gain in the stock and you're looking to lock in profit by using a put option, in that insurance tool, you can look to sell that call as well, and you might get some good opportunities there for a conversion if you have a gain in the stock already. All right, ladies and gentlemen, it's almost 5:30. Time flies when you're having a lot of fun. I don't see any other questions, so what I'm going to do is navigate over to the slide presentation to wrap up for today, but I'll stay online for a little bit more. So if you have other questions that didn't get answered, even if you think it might be a 10 or 12-minute answer for your question, I'll just prompt everyone, go ahead and send in your last-minute questions. We might field a few more questions here before we close out for the day. While you guys are putting in your questions, ladies and gentlemen, you're putting in your questions, I should say, I'm just going to go ahead and wrap up here. Just want to let you know about the subscription costs for Power Options, the tools we use today. The 20-minute delayed service gives you access to all of the tools in the tool menu with 20-minute delayed quotes. It's $59.95 per month or a discounted rate of $600 for the year. We also offer a real-time service. It's not streaming real-time, but every time you refresh the page, rerun a search, you're getting the numbers at that very instant. The real-time is $79.90 per month or discounted rate of $800 per year. Now, our historical data, the backtesting tools, are not available on the 20-minute delayed or the real-time subscription. You can get a 3-month access to the historical tools on top of one of the regular subscriptions for $99.95. Works out to be about $33 per month. But if you're already on the real-time, it's actually cheaper just to upgrade to our professional level of service. The professional level of service includes everything on the real-time service with unlimited access to the historical suite of tools, and that's only $99.99 per month, or a discounted rate of $1,000 for the year. Upcoming presentations, every Tuesday and Thursday at 12 noon, Kurt Frankenberg hosts his radioactive trading presentations. On Tuesdays or Wednesdays at 9 p.m., it sometimes alternates. I do a full presentations on using the Power Options tools for radioactive traders. We just held one this Thursday because Kurt was unavailable, and I thought it would be a good time to just focus on the Power Options tools for the Thursday presentation. Every Wednesday at 12 noon, I host an Introduction to Power Options presentation. Then, of course, every Friday at 4:30, we host these open discussion forums, these open discussion presentations. Now, if you think of a question later on that you didn't get a chance to ask during the presentation, please email me to support@powerup.com. If anyone remembers later this week, remind me to change the slide because you can barely read that. I don't know why it went to an automatic sort of link, and it's almost the same color as the background. So I'll try to change that and make sure it's not a link so you can actually read the email address. Or you can also call us toll-free during market hours. If you live inside the continental U.S., you can reach us toll-free at 877-992-7971, or you can reach us at 302-992-7971 if you live outside the continental U.S. Of course, there are also contact links at every page on Power Options. All right, ladies and gentlemen, thank you again for joining me this afternoon. I hope you all had a fantastic week and you have a great weekend ahead, and I look forward to seeing you at one of our other live presentations next week as we get closer to January expiration. Again, please feel free to email me or give me a call during market hours if you have any questions that you think of later. Take care, happy trading, and we'll talk to you soon. Good night.